Diaz is just joining us. And there is our department clerk. Commissioner Diaz is here. We have a full complement of board members this evening. And we do have the one item on the agenda. And I'm going to turn it over to Mike Brewy. Mike, maybe just give a couple minutes of background here in your role.
Yeah, let me, yeah. Good evening, everybody. Great to see everybody again, even those that I haven't met yet. A shout out to Lieutenant Lyons for all your help in pulling this together and getting all these books distributed, and also setting the Zoom meeting up for us, because we couldn't have handled it, believe me. Anyway, thanks for letting us join your meeting tonight. For our presentation of and review of the Bridgeport Police Pension Plan B. The review reflects, just for your edification, the review is going to reflect performances from the second quarter of 2025, which ended a couple of weeks ago on June 30th. So it's pretty current where we stand. For those that may not know me, my name is Mike Brewy. I am branch manager and principal owner of the Raymond James office in Wilton, Connecticut, and I oversee the total Bridgeport Police Pension Plan B, which consists of 3 different management firms: Estabrook Capital Management, Wright Investor Service, and as well as Raymond James. Dave Foley, who is over here. Hi, Dave. He is COO and portfolio manager of Estabrook Capital Management, and he'll start us off with and present Estabrook's portion of the pension plan first. Amit Khandwala, who is chairman, CEO, and CIO of Wright Investor Service, will present Wright's portion of the plan next. And then I will present the Raymond James portion of the plan, and I'm going to provide a wrap-up summary of the financials and the performance of the consolidated plan with all of the 3 managers at the very end of the presentation. Okay? Christopher Gacci of UBS Financial Services. I don't know if he's here. Chris, are you here?
I'm here. Yeah, I'm here. Okay. Hi, everyone.
Chris handles, as you probably know, all the retirement distributions. He's an important guy here for us, and he'll be joining us on the Zoom call as well, as you can hear. Anyway, we're going to keep the presentations fairly brief, but don't hesitate if you to ask any questions as we go throughout the process here. David, when you're ready, I'm going to hand it over to you. And when you're done, if you could leave the meeting, because then I'm going to call Amit Khandwala, and he's going to present his portion of the Wright plan. Okay? So, David, you're on.
Terrific. Thank you all very much. And I hope you're having a great evening, and thank you for taking the time to meet with us this evening. As Mike mentioned, I'm from Estabrook Capital Management. And if you have our books in front of you, just for those of you that remember us from prior years, not a heck of a lot has changed. For those of you that are new, Estabrook is a privately held registered investment advisor. We have offices in New York City and an office in Jacksonville, Florida. We have been in this business for a long time. The Estabrook as a firm dates back to the 1860s. The investment advisory arm of that firm dates to the 1920s. So we're around our 100th anniversary. As a owner of the firm, obviously it's incredibly important to me that there's another 100 years in the firm. So the way in which we manage money and the way in which we think about things has a lot to do with that sort of time period, with that sort of thinking, with that sort of bias as we approach things, as all of that is crucially important to us. And that's reflected in how we approach asset management or management of accounts. In terms of doing that, if you turn to page 3, generally how we approach things is we start off with a forecast of what we see going on. What is our macroeconomic forecast? And I'll get to a little bit of how we see things before talking about the portfolio in a minute. Then sort of what trends are there, doing a fair amount of research on that, looking at stocks, looking at sectors, and then obviously after investments, what are your risk managements? How do you manage that risk? How do you manage that investment as we go forward? If we flip to page 4, one thing that comes up a lot in how we think about things is risk management. And at its core, people like us who do this kind of work, we're really risk managers. And that means, how do we approach that? We have a meeting every day where we talk about whatever occurred in the last 24 hours, mostly this time of year, it's a lot of company earnings, which you might have seen on TV recently. You get those at this time of year. We also have a couple of larger meetings every week where we really discuss sort of the economics, how we feel about things, where we generally see things going. We do a fair amount of reviewing of position sizes and sector allocations as well, and then look at how we're performing relative to benchmarks and things like that. That's a bit of the background of Estabrook and how we operate. I'm going to get into sort of the portfolio and performance and what does it look like here on page 6. So you've got to flip a page. On performance over the last numbers of years, as you're probably well aware, markets have done quite well relative to history. And we have definitely benefited from that and had really pretty good returns over that time period. And just from a standpoint, if you look at our 10-year number or even the 5-year number, just historical market returns for all stocks are about a little less than 10%. We're running a portfolio that has about 65% invested in stocks. And over the last 5 years, we've been up north of 10%. So that's really terrific. And we've seen some good market returns. Again, over the last couple of years or last couple of months, there's been a fair amount of volatility around that, whether that's tariffs or some of the things that come out of Washington, which can get people relatively anxious. But the economy and markets have continued to power along. If we look at page 7, here's a bit of our allocation in the portfolio. So as you can see, as of June 30th, we're about 66% invested in stocks. And the remaining allocation of 35 is between some fixed income and cash. We had a bond come due right at the end of the year. So that's end of the quarter there on June 30th. So that's what's reflected in a higher cash position, which we did get reinvested relatively quickly in early on. As we get to sort of just a general outlook for markets, which would be page 8, one of the things that comes up is how do we feel about fixed income? That's about the 35% of the account, bonds and cash. As you are probably well aware, we have seen the Federal Reserve has lowered interest rates starting about last summer, and they're still higher than what we might recall in recent memory, meaning they sit somewhere between 4.25% and 4.5% is what the Federal Reserve rates are. Your 10-year Treasury is yielding about 4.5%, and that translates into a mortgage rate of somewhere a little bit below 7% today. And you all probably remember in the not so distant past when mortgage rates were, below 4%, below 3%, and that really allowed the housing market to take off. Obviously, higher rates make that a little bit more difficult. Markets expect the Fed to cut twice this year and then to cut a handful of times next year. So their hope is that by the end of next year, the Federal Reserve will have interest rates at around 3%. And what's going to keep that there if, inflation, which has come down dramatically, follows that path, and if employment holds together, which it has thus far over the last, number of months after a worry in the fall. Obviously, tariffs, which we saw recently, and how those all play out have added to some level of uncertainty around what's going to happen with inflation. We've yet to see tariffs really show up in the inflation indexes. Yesterday, we had the consumer price index that came out, and we didn't really have any impacts from tariffs yet. Will that show up or not? It will, is still to be determined. It hasn't shown up yet. The Federal Reserve has been pretty nervous and antsy that tariffs will show up, but it just hasn't totally materialized yet. Again, still early innings in whether that happens or not, but we will see. If we get a couple of rate cuts, that's obviously going to be a little bit more positive for the economy and be able to send, perhaps stocks higher, asset prices higher, would be good for housing and things like that also. If we go to the next page, this is about our kind of equity weightings and our allocation of stocks. One of the things that's happened over the last numbers of years is that information technology, the technology sector of the S&P 500 has become very, very large as a percent of the overall index. It represents now about a third of the overall index. We're relatively close to that with about 29% of our portfolio, of the equity portion of our portfolio is in technology. And why has that happened more recently? Obviously, we've seen a lot around AI has been a massive driver of those kind of stocks over the last numbers of years. And generally other companies like Apple, which is a big component of the S&P 500, will be somewhat involved in AI, but isn't really the lion's share of it in a way like a Microsoft or NVIDIA, which is the major chip manufacturer, has been recently. Financials is another area where we actually have a lot of exposure relative to the S&P 500, and that sector has done wonderfully well for us over the last couple of years. And some of this has been a long kind of run out of the great financial crisis, but banks generally have done quite well over the last few years, and we feel that there's a chance for them to continue to do well. Consumer staples represents, again, a larger portion of our portfolio than the benchmark. And, we view those as relatively safe, less risky type companies, meaning, somebody's always going to eat their breakfast cereal and may cut out going out to eat at the restaurant or something like that if the economy gets a little harder for them. Healthcare, another sector that, while we have a decent exposure relatively similar to the benchmark, it's been a frustrating sector for us this year. Healthcare did fantastically well through COVID, but since then it's struggled. The interesting stat around that, and this is something that, as you all are probably quite aware, is that, something like 11,000 people a day turn 65 in America. So we have a demographic issue here that's going to require a lot of healthcare and makes us kind of excited and interested in some of those names. And whether that's from a pharmaceutical company to a manufacturer of tongue depressors. So those are, those sort of areas. As you can see, industrials is another area that's we're about similar to the S&P 500, and that has also done quite well. A lot of the industrial boom over the last bit has had to do with power and power generation for all of the new expected power demands out of AI, if that makes sense to you. So, you're going to see a lot of, recently we were seeing a decline in the expectations for power usage in America as homes get more efficient and things like that. But with AI now and the big data centers that need to be built, you're going to see a lot more power used than people had been expected. So you see that, and you also see increased demand for things like airplanes and airplane engines and such, as more people globally get on a plane compared with when I grew up, I guess. So industrials, communication services, that's going to be telecom, AT&T, Verizon, those kind of companies. They tend to pay high dividends, be a little bit safer, but nothing super exciting associated with them. Energy, we're a little bit overexposed to relative to the benchmark. Energy had a good start to the year, and then as the technology sort of side of things took off a little bit, it lagged some. But we believe that there will be, out of a lot of this AI and calls for power, a lot more demand for natural gas. I think that, and that's what goes to power a lot of those plants. I think, classically people were hoping that energy would lead to a lot more gasoline consumption, while electric cars might be not as popular as they once were. That we'll continue to see that shift of that. And a lot of that power will be created in a, utility plant versus getting it in the engine of your car. Utilities, as we're a little bit overexposed to, again, big uptick in demand for them going forward as well. Consumer discretionary, those are kind of all sorts of, if you think about those are going to be your kind of luxury goods stores, high-end things like that. We're relatively less exposed to those because we've been a little bit worried about the shape of the consumer over the last bit of time as, inflation and things like that have gotten hard for people to handle, all of those kind of expenses and things like that. The final sector, real estate, again, a very small sector of the S&P 500, we have no exposure to that. And generally outside of some of the other names that would be involved in that, maybe making things like the thermostat in your house and stuff like that, we're not really involved in owning at present any of those real estate companies. I think with where interest rates are in that environment, it's going to be a little bit difficult until we see rates come down, perhaps some more tailwinds for the housing market to take off, and that would be a time when we can look at those sort of names. Does anybody have any questions about the sector allocation and how that looks?
Any questions?
All right, terrific. If we go to the next page, we can get into the individual portfolio. And I'm not going to talk about each individual stock, but I do want to highlight a couple of them that bring up some of the themes that I sort of was addressing a little bit here. And the first one I want to touch on is Eaton, which is on page 10. Eaton is an industrial company and they're in the power business. And what's so interesting about them is that they're really helping utilities and any kind of IT company build out the infrastructure in order to do all of their increased power demands that we're going to see coming out of AI. So it's a really interesting sort of thing as that they're kind of helping utilities, helping companies figure this sort of stuff out. So that's a real sort of unique place. As we move on, I mentioned Home Depot is another area. I touched a little bit on real estate that we don't have much exposure, but a Home Depot is obviously a place that anybody who's buying a home or just bought a home goes and shops at. Another great company, great stock that we've owned and has been unbelievably successful for us has been Costco. There's a general, it seems today that at least in the stock world that Costco, Amazon, and Walmart are sort of taking over retail in a way that we hadn't necessarily seen before. And they're kind of doing that from the grocery store component all the way up to the clothing and electronics, again, in a way that when I grew up, you had to go to 5 different stores to satisfy all of that. So Costco's been a really fabulous holding for us. I mentioned some of the consumer staples companies like a Pepsi or a Procter & Gamble. And those companies have been a little frustrating year to date, but have been generally good holding for us. On the healthcare front, I mentioned that healthcare have been a little bit frustrating for us as well, just simply because the returns hadn't been great. And in there, one of the important things I want to point out for you is if you look at the dividend yield, which is that all the way on the right, for us, they have relatively high dividend yields and provide a really good source of income for us. And that's, when companies pay you a dividend, you're getting some money every quarter, and that's helpful and provides a level of security. It means a little bit lower risk. So that's been wonderful for us. If we look at the financial sector, we've had, again, all of the banks year to date have done quite well. Chubb was an insurance company, has done quite well. But financials is really, as a whole, each of those banks has done well. JP Morgan is probably the best performing, the largest bank out there as well. And that has all been, provided really fabulous returns for us. As I mentioned, I think those banks can continue to do well. Their earnings came out in the last day, yesterday and today, and I thought they were quite good. So they're operating, everything is sort of working fine. And as long as the economy holds together, which we believe it will, the bank should do quite well. We're not really seeing defaults or those sort of things in a way that you might get yourself quite concerned about. And listening to them, the credit card defaults and things like that are awfully low. As we move to the information technology sector, obviously you can see Microsoft is a large holding for us. Well, that's sort of a similar weight to what Microsoft is in the S&P 500, and it has been a fabulous holding. Really been a wonderful stock for us to own over the last numbers of years. If we flip the page, as you see in communication services, we own AT&T and Verizon. Those I sort of mentioned as higher dividend payers, somewhat steady eddies. We own some Google or Alphabet in there as well. And we believe that Alphabet will be a player, obviously, in the AI future. We own some utilities as well, Duke and NextEra, a couple of preferred stocks, which pay some higher dividends and a little bit of an anchor to windward. And then the fixed income portion of our portfolio at present is entirely comprised of U.S. government bonds. As I think I've mentioned before, we've really been interested in trying to buy some corporate bonds. But at present, you don't get paid enough to own corporate bonds over treasuries. If treasuries are the most safe and corporate bonds are a little bit more risky, the spread that you get between the two just isn't big enough to make you want to go buy them. I look at them every day and I just haven't seen anything that really is appealing on that front. And if it does get appealing, then we'll buy them. The other thing on the bond front is we've remained relatively short, meaning we're not buying bonds that are 10 years. We're buying bonds that are due within a couple of years. If the Federal Reserve does cut interest rates and bring that front end, what you can get on a 2-year bond, the return down, we'll probably look to lengthen out and go somewhere where we could get better returns further out the yield curve. So that may mean buying a 3 or 5-year bond. As we get to the economic outlook.
Why don't you join us in about 5 minutes? Okay. All right. Very good. And David is just finishing up his, and then we'll get you on as soon as he's finished. But you can join in about 5. Okay.
All right. As we get to the economic outlook, CPI report. This is page 15. The CPI report came out yesterday. Again, in May, it was 2.4%. We're really just, a touch above 2% at present. So inflation and the inflation that we had throughout late 2023, early 2024 has really abated and come down dramatically back to a level that's kind of more normal in a historic range. So we're very close. The Federal Reserve wants inflation to be around 2%. We're almost there, which is a bit why you hear the president really wanting the Federal Reserve to cut interest rates, because we're sort of back to where we are. And it looks like we're on that path. As I mentioned, concerns around tariffs could send things higher, but at present, it hasn't shown up yet. It may, but it hasn't. If we look at unemployment, unemployment in the U.S. is incredibly low relative to history at a touch over 4%. So again, the employment picture is quite strong. Wage growth is still there. And job openings, which we saw maybe a week or two ago, are pretty high. It seems that if you want a job, it's available to go get. That remains, if employment got a lot worse, you could see the Federal Reserve get a lot more concerned about interest rates and try to stimulate the economy some. But presently where they are, we're in a good place on employment. And, general questions, and I don't know, it's unclear. You see at least, does immigration and the slowdown of immigration, will that have effect on wages and jobs and things like that? Like, time will tell. It hasn't really shown up yet. So we'll have to see how that plays out. And so in short, we're generally optimistic on the economy. We feel okay about things. We've had good market returns over the last couple of years. We think that we'll have relatively good returns throughout the rest of the year. At some point, we have a lot of debt and a lot of these sort of issues that we've kicked, where we've kicked cans down the road. And at some point they will rear their head. We just haven't seen that happen yet. I might have thought that would have occurred a couple of years ago, but it just hasn't happened. And it seems that the economy still has a fair amount of tailwinds behind it and ought to be able to do okay. Are there any questions I can answer for you?
Just quickly, the 65% that you have invested in stocks, you're saying the return has been on average 10%?
So of the total portfolio, so that's going to be stocks and bonds, okay? Which again, bonds have had a lower rate of return than stocks. Over the last 5 years, we've returned in the total portfolio about 10.2%. So it's done very well over that time period. To think that, historical stock market only returns are less than 10%. I'm just making the observation that markets over the last couple of years have done quite well. We've done very well with that as well. In that. Thanks. And that's, really been terrific for everybody.
Any of
Hey,
the
Dave.
commissioners have any questions for Mr. Foley? Ed? Commissioner
Just
Farrell?
Yeah, just out of curiosity, you kept mentioning we having meetings and we are doing this and we are making this. How many are we? And
Fabulous question. Yes. So Estabrook, we have about 15 employees. And of the investment professionals, there are 6 of us. So that is the group that is the core investment professionals.
Got
And
it.
a 9 support staff, if that makes sense.
I got it now.
Okay.
I was just trying to understand, like, is we have as across several different
Is it
companies, several
no,
offices, or
so we have 2 offices. I'm based out of the Florida office. We have in Florida, there's 3 of us, and New York still has the lion's share of our employees. I've tried to get many of them to move to Florida. I had one move down and one move back north because they missed the Northeast too much, which I found shocking. But anyways, so that is the group, and there's 6 of us investment professionals in that, and those are the sort of the core group that meets every day.
got it. Thank you, David.
Yes, sir.
Hey, Dave, it's Mike. I've got a question. If the tariffs really kick in, if we run into problems in the near future, which is a distinct possibility at this point, what adjustments do you think you might be making to your portfolio to address those events that are coming up? The economy is doing great right now, the base economy, but we do have this looming, catastrophe if things don't, mollify everyone's concern about tariffs. Do you have any thoughts on that?
Definitely. And what a really neat question. So that would probably mean that inflation would go back up from that 2.6 number that we were looking at, or 2.4. And that may mean that interest rates would have a hard time getting, the cuts that we talked about would probably get shelved a little bit. We might see some longer term interest rates go up. So we'd really look on the fixed income side of things, of saying, where is an attractive place to enter? And get more excited there. Within that, given that we have a couple of levers, we might lower our equity allocation, which I mentioned was around 66%. We might lower that back down to 62 because I'd be a little bit worried about the impacts that would have on the equity market, and specifically on a couple of names within there that really rely on a lot of imports into the US. Nike, for example, has done okay. They said they were going to raise prices, but if the tariffs really started to bite, a handful of those kind of securities we would probably own a lot less of, if that follows. So I would be really concerned about those sorts of companies. I don't know that the tariffs are going to have a big impact on a Microsoft, for example, simply because a lot of that is, they're a massive global company. AI is a big build out that's going to get built out regardless of what tariffs are going to do. But if that started some trade wars with China and that product, so ultimately, there's a number of different levers to pull in there, and we'd really be focused on if the inflation was coming back, how would that impact the fixed income? How would it impact your allocation? And then what exactly we do within the stocks.
Okay, good. Thank you. Yeah. Any other questions?
Thank you, Dave.
Hey, thank you all very much and have a fabulous evening.
I just have one quick question, David.
Yes, sir.
Yeah. So I've been talking to a number of guys who have private equities and all this other stuff they're working with, and they were telling me they've essentially been ignoring I guess initially everybody was responding to tariffs today, no tariffs tomorrow, and they were responding and coming in and out of the market. And some of the guys I've been talking to are saying they're just simply ignoring all of that and just moving forward. Is that that kind of the posture you're taking, or is this something that we should be concerned?
I think, what's hard is that I grew up in a world that when the president says something, we take it at its face. Now Donald Trump is a different president than what we have seen in the past. So there was a term that came out recently called taco, which was, and this is what people in the market were thinking, is that Trump always chickens out. And there's an unpredictability in how he does things, which has yielded him a lot of success, but it gives certain people a lot of, anxiety. So I think the markets have generally thought that he would come out and say something that might be a bridge too far. And at some point early in in April, they got quite anxious about it, and then he backed away. But I also think that at least his approach to things, he's somewhat of a realist. And he saw in April, boy, these tariffs things were getting people quite antsy. So I have to back away from them. Right. So there's a number of these different things. So again, I think that there is a sense that, if he says he's going to do something, we all have a sense that that will occur, but maybe he might change his mind. And that's where he's been quite nimble around sort of seeing how things happen. So he implemented, there's supposed to be some new tariffs coming in on August 1st. I think markets have generally expected that they might not be as severe. Okay. But it's a little bit like you've got to be a little cautious because they might be. So it adds a level of uncertainty, but you can see that markets have said, we're not as concerned as we were in early April. And I think they've generally been right thus far. That's not to say they're going to be right on August 1st, but there's a concern about that. So people have sort of started to look through some of that. And maybe the simple fact is that Trump perceives is a bit of a realist in that, he's not going to do anything that totally derails the economy or markets, because that would be a big mistake. So I think that there's a more of a willingness now to look through some of that stuff, but it's there's always a sense of saying, it might be problematic, and that can get you a little bit anxious. And so I'm not saying it's an all clear, we're great, but if that were to change, we'd react accordingly and be engaged with that if some of this stuff were to roll over or any of those kind of things. And again, we all feel great about the economy. You can feel pretty good about it at present, but that could roll over too. At the end of this year, if the tariffs had a big bite, if we saw unemployment spike up and those things, but we just haven't seen that yet in the data.
Thanks, Dave.
You bet. Thank you.
Thanks, Dave.
All right. Thank you all. Have a great evening.
All right. Take care. Speak to you soon.
Thank you.
Take care. Bye-bye. Okay. We've got Amit ready in the wings here. And I'm going to try to get him in.
I think he's with us already.
Yeah.
Oh, there you are.
Good evening.
Amit, how are you?
Good, thank you.
Okay. All right. Well, ready to go. So if you're ready, why don't you begin your presentation of the right portion of the plan?
Yeah, sure. I guess you already heard a little bit about the economy, so I'm ready to answer any questions on our stance on that if need be. But in the interest of time, I'll just dive into the presentation on the performance. So if you have the presentation in front of you, I'll turn to page number 4. And this is the current allocation for the City of Bridgeport Police Officers Pension Fund B. As of June 30th, the account is $27.3 million. It's divided 62% in equities, about 37% in fixed income, and it's got, basically frictional cash, which is waiting to get invested from either maturing bonds or dividends that were received on stocks. On the equity side, your portfolio is divided between really mostly on the value side, I would say. It has a pretty significant exposure to large cap core, which is the blend. So you have some growth over there, but then you also have dividend income stocks, which had a very good return in the first half of this year. And then large cap growth stocks at about 9.1%. And the winner of all of these has been international equities, because international equities had a fantastic first quarter and ended the second quarter just slightly behind the S&P, but still double-digit returns for the first half of this year. And on turning to page 5, you can see that the first column is the calendar year return, and then on the right side is your fiscal year return. And your fiscal year is June of June 30th of a given year. So on the calendar period, your account started the year, meaning started January 1st of 2025 at about $25.8 million. Income that was added to your account was about $202,000. But the investment gain, meaning capital appreciation on your account, was a very nice $1.3 million, bringing the total investment return to about 1.5 million just in the first 6 months of this year. Ending market value is about 27.3. Now, if you look at the fiscal year period, your fiscal year started with at about 24.7 million. We added total investment return of $2.6 million, and bringing the ending market value to, again, 27.2. So your fiscal year period has a little bit more time there, almost 12 months there, compared to the calendar, which was only 6 months. So 6 months of this year, you had a very, very good return. Now, remember that we started the year a little bit shaky with all the tariffs and so on. But nevertheless, we ended the quarter and the year, this first half, pretty strong. Every one quarter can be a different period, could be up, could be down, but we really like to focus on what we have generated for the pension plan from the time we've been managing the assets. And you can see here that since we managed the assets a long time ago, April 25, 1994, the deposits that the pension plan made was $1 million. And we have created net returns after fees of almost $26.5 million. So the account has done very, very well during this period. If you turn to the next page, there are a lot of numbers there, but if you would be kind enough and just go to the net return, which is about 4 columns to the right, that is the account performance net of all our fees. And you can see that in 2024, which is 3 lines down, the account was up 12.3%. You fast forward that a little bit further down to the 1-year period, all the way down through June 30th. This year alone, you have, meaning last 12 months, you have returned 10.8, almost 11%. And 3 years, your account every year has gone up by about 11.2%. So very, very strong returns. Just to give you a little bit of a historical comparison, on an average, S&P goes up about 8.5%, including dividends on an annualized basis. So, we cannot count on these kind of returns every year. But 2023, the S&P was up 26%. 2024, it was up 25%. So we've had very significant returns in the equity markets. The valuations now seem to be a little bit more on the higher side, not an excessive valuation, but not cheap either. And I'm talking based on expected returns based on the earnings. So with that, your portfolio is very well diversified. You have a pretty large amount in equities. Again, relative to the benchmark, we are not really significantly overweighted. And within the equity, you have a tilt towards value. So if tomorrow we do have a bit of a sell-off in the markets, which is more likely than not, then you will have some protection in meaning less volatility with holding dividend-paying stocks. So if the market goes down, the companies that we own in your dividend portfolio are very, very high-quality names, and they will hopefully go down less than the benchmark. But at the same time, you can collect the coupon till the market reverts back to a decent value. So with that, I will open it up for any questions that you may have. And be glad to answer those.
Commissioners have any questions?
That's good.
Just have a
Mike, any
question.
comments?
Looks good.
Yes.
I have a question. Is it common that the calendar and fiscal year to end the market value at the same?
Yes, because what we are doing is doing fiscal period it just so happened this time around that because the
Identical.
fiscal year ends in June, that's the only reason. But
Okay.
generally, they would be different. Yes.
Okay. All right. Thank you.
Good observation, though.
Mhm.
Very good. Good, Amit. Thank you.
All right.
Anybody else? Any questions?
Thank you.
Yes, sir.
Commissioner Farrell, you're muted, but you had your hand up.
No, I was just curious because I noticed that both of you, as far as equities are concerned, are pretty much in the same ballpark. I mean, cash, you're a little bit lighter on cash than Estabrook, but is that just the standard to be within that range, like 2/3 to having equities versus all the other investments or cash position and everything else?
Yeah, the cash position is mostly frictional cash, which we get because a bond matures and is waiting to get reinvested, or we have received dividends from stocks that also need to get invested. So the cash is very little. We generally can go in a range of between 55 to 75 in equities. What determines the allocation is based on the investment policy statement that guidelines that we have. So we are always within those guidelines, but we are actively managing. So it's not always at this range. When we feel that the markets are cheaper, we can go higher. Right now, we don't have a very aggressive exposure to the equities relative to the guidelines. So the guidelines will say, how much you can be in equities and what the midpoint is. We are not too far away from the midpoint because we feel that the equities are kind of done quite well. And therefore, we want to be a little bit more conservative. So we have done two things. One is we are not more in equities. And number two, we are more in value stocks because growth stocks are done extremely well. We have growth stocks in your portfolio. Don't get me wrong. So if this rally continues, you're going to participate in that. But if tomorrow there is a retrenchment in the performance in the markets, you will have some protection by being in dividend-paying stocks and having more value exposure. Mind you, they will all go down if the market crashes, but value stocks will go down less than growth stocks because they are less sensitive to changes in interest rates.
So are you saying that this kind of 55 or 50% to 75% is the industry standard?
Not an industry standard. Each pension plan is different than another. And what determines the pension plan's ability to take on higher risk or low risk is determined and specified in the investment policy guidelines. So some pension plans will have only 20% equities, and they will state that because they have a huge amount of payments that are being made every month. And so they cannot afford the risk of equities. But some other pension plans, they have a very long-term investment horizon. And so they want to grow the principal. So if you remember, I showed you that when this plan started, it only started with $1 million. That's all that was put in this. Today, your account is at $27 million, but that would have not been the case if you had only 25% in equities. So what made your pension plan grow is the growth of the equity market.
Thank you. Appreciate it.
The other thing, Commissioner Farrow, is Estabrook holds some extra money cash because it has to provide money to UBS to pay the retiree distributions. So that's why they always have a little bit more cash than they would normally have. It should, otherwise they would be more fully invested than the amount of cash that they have in their account presently.
That makes sense. Thanks,
Yep.
Mike.
Yep.
Yeah.
Okay.
I have a question when you said that they're paying out the pension. So in the event that they're holding that cash and the officers who are on this pension, let's just say there might be fewer on the pension, what happens with the extra, I don't know if you want to call it, investment when it's all, the officers have all transitioned?
That's a good question. I can't answer that question right now because there's a lot of retirees and a lot of money is going out every month to the retirees, quite a bit, as a matter of fact. We've got so far since the MERS transfer, which was in 2013, we have already withdrawn $42 million in retirement distributions. We have a lot more to go. So we got to keep one step ahead just to make sure that we don't fall behind. Yeah, so yeah, we got a long way to go. So I don't know what's going to happen at the end. But hopefully we're going to have, the idea is to have plenty of money for the retirees for the rest of their lives.
Thank you.
You're welcome. Good question. Okay. All right, Ahmed, I think you can leave now and we'll just finish up our portion of the presentation. All right?
Thank you, everybody. Have a
Thank
great
you, sir.
evening.
Thanks, Ahmed. I'll talk to you soon.
Okay.
Thanks. Bye-bye now. Okay. I'm going to just provide a brief overview of the Raymond James portion of this plan, and I'll finish with a summary of performance and finances of the consolidated plan with all three managers at the very end. So I'm just going to walk you through the Raymond James portion of this plan and basically what's in it and why it's there, why it's in it and what it's doing for us relative to some of the questions that you've been asking. And if I could, let me see if I can share the screen. Post-disabled participant sharing of the screen. Guess I can't share the screen with the presentation.
I think you gotta get permissions. Alyssa may have to give you permission.
I think so, yes. Hi, Liz, are you still there?
Yeah,
Nope.
I'm here. I'm
Oh,
looking.
I'm sorry. Okay. I was trying to share the screen, and I'm not able to do that. Is it possible for you to allow that for me to share the screen? At this
Yes, I
point?
can try right now.
Okay.
You can try now.
Okay. Let's see. Oh, there we go. There we go. That's great. Thank you so much. Okay, and let's see if we can open this up all the way. Just bear with me. And what I'm trying to do is just share it with you so that you don't have to keep looking at your thing. I don't know how to open it up any further than this. I think what's happened here, it looks like.
Mike, it looks like it's large enough if
Can you see, can you read it? Okay, it's probably good enough. All right, guys, let me just run through this. We're going to start very broad on our portfolio at Raymond James. I'm going to walk you through this fairly briefly. We're going to start very broad with asset allocations, cash, bonds, stocks, and alternatives. The style of the bonds, the style of the stocks, a deeper look at the equity sector, but specifically the different types of industries that are in the stocks that are exposed in this portfolio. A deeper look at the fixed income bond sector, and then we're going to look globally, U.S. and international investments, then portfolio performance, value over time. And then finally, I'm going to wrap it up at the end with a summary of the composite portfolio, all of the managers. So with that, I'm just going to move on to section 1, the asset allocation. You can only invest in 4 different things, really: cash, bonds, stocks, and alternative investments. As far as cash is concerned, we have very, very little cash available in our account. We only have about $60,000 in this account. And this account is over $37 million. We've got very little cash in there. That may change later when I talk about what my recommendation is later on. But everything is fully invested. All the cash is fully invested in this portfolio.
Hey,
As
Mike.
far as bonds are concerned, we only have 5% in bonds in this portfolio. And the reason for that is that the other managers, they have a fair amount of bonds in their portfolios. If I add a lot more bonds in this portfolio, we'll have more bonds than I think we want to have in the total portfolio.
Mike, can you hit that X where it says all tools up there? That tiny X up at the top where it says all tools on the opposite side.
The opposite side.
Right there. You see that X?
Oh, I'm sorry. Oh, that helps. Okay. Is that better? Can you see it?
That's a little better.
I don't know why I can't open this up broader, but let me see if I can do it this way. Maybe that'll help a little bit. Not much.
I can see it better now.
Okay, I'm sorry about that.
Well, this is the same thing we have in front of us,
Yes, it is.
Mike.
Yes,
So
it is. Okay. Anyway, all right. So bonds, like I said, we only have 5% bonds in this portfolio because I look at the other guys' portfolios and I want to make sure that this is balanced properly. So, and alternative investments. Alternative investments are very non-traditional investments. They're things like currencies and precious metals and options and jewelry and art and some real estate and things like that. These are things that don't belong in a portfolio like this. They're a bit too risky. We have a very small percentage in that for diversification reasons only 2%. The bulk of our investments are in stocks in this portfolio for the reasons I just discussed, because we have enough bonds in the consolidated portfolio without going over, I think, the limit. Okay, so the next section is the style analysis. As you can see here, there's 2 box charts on the top of this page. On the left-hand side is all about the stocks, and the right-hand side is all about bonds. We start with the stocks on the left-hand side. On the left-hand side of that box chart, you see the capitalizations. You see these are large cap stocks or mid cap stocks or small cap stocks in this portfolio. The bulk of our assets, over 70%, are large cap stocks. And as you've heard before from the other managers, these are stocks that are more companies that are more stable, that are established, that are fairly conservative, and are quote unquote safer. So the bulk of our money and the bulk of our investments are in large cap stocks. That's where we belong. We do have some mid cap stocks. We do have some small cap stocks, but very little. And they're there for diversification purposes only. All right. And again, if you have any questions, please jump out. I can't really see you, so I'm looking at the page here. Across the top of this stock box chart, you see there are really 2 different styles and 2 different types of stocks. There's growth-oriented stocks, which we talked about with the other managers, and there are value stocks. In this particular portfolio, we have a considerable amount of value stocks versus growth stocks. And the reason for that is because the other portfolio managers have more growth-oriented stocks in their portfolios. What I did was make sure we had enough value stocks to give a nice balance between value and growth. growth are those companies like Apple. They throw all the money that they earn back into the country for growth orientation. They don't usually throw off a lot of dividends. Value stocks, on the other hand, undervalued. So to get you to buy their stocks, for the most part, they have to give you better dividends, good dividends. So we're getting some really nice dividends from the value stocks, and they are safer relative to the growth stocks. So what this does is this tries to balance out what's in the other manager's portfolio with what we have here to make sure everything's in the proper balance. And it depends on the market, depends on the economy, depends on a lot of stuff. In very high growth periods, you want more growth-oriented stocks than, say, value stocks. But in times like these that are uncertain, it's good to have a good balance between value stocks and growth stocks. And we have it here in the Raymond James portfolio. If we move over to the bond box chart, on the left-hand side, has to do with the credit quality of the bonds that are in the portfolio. Again, we don't have a lot of bonds in the portfolio, but this has to do with the credit quality of the bonds. You have high credit quality, you have medium credit quality, you have low credit quality. We don't have anything in high quality because they're not throwing off a lot of income for us, and we certainly don't have anything in low quality bonds because they're just high yield bonds and they don't belong in a portfolio like this. They may belong in your portfolio, but they don't belong in a moderate conservative portfolio like the Bridgeport Pension Fund. All of our bond investments, and again, we don't have a lot of them, are in the medium credit quality range, gives us some nice income as well as a little bit of safety because they're not low quality bonds, they're good quality bonds. Across the top has to do with maturities of these bonds. You have short-term maturities, intermediate-term maturities, and long-term maturities. Once again, 100% of our bonds are in intermediate term maturities. And the reason for that is that long-term maturities, long-term bonds are not paying very much, enough for you to set aside money, a lot of money for long periods of time. There's not much of a yield difference between long-term bonds and intermediate term bonds right now. So it doesn't make any sense. So that's why we have all of our bonds in intermediate term. Once again, we're getting a good yield on these bonds, and they're relatively safe to these long-term bonds, which aren't paying enough for us to set aside, a lot of money for long periods of time. Okay. Let's take a deeper look at the equity sector, and you've seen this in the other portfolios as well. And that is, this is all about stocks, and these are the categories, the industrial categories of stocks. There are 11 major categories of industries that you can have in stocks. They start with basic materials, go all the way down to technology. As you can see, a lot of the shorter colored, but we have something in all of the different industrial categories or business categories, which is good. We want that. The shorter bars, though, are the ones that are less favored than the longer bars. The longer bars are the most favored categories right now in this market. They include consumer cyclical, financial services, healthcare, communication services, industrials, and technology. And again, the other guys touched on some of these points as well. If you'll notice, the technology bar is pretty far advanced. The allocation is higher than the other ones. And that's simply because tech is booming. It is the most favored of all of the different categories. And it's benefited by the high interest in the AI, the blooming AI industry. So right now, we can afford to invest a little bit more in technology stocks simply because they're going to do well. They have been doing well, and we expect it to continue in the future. So that's stocks. Fixed income, again, we've got a smattering of all different types of bond investments. but most of them, the longest bar there at the bottom is the government. These are government bonds. They're there for safety purposes. We also have corporate bonds as the next largest allocation, and they're providing some income. The other stuff is just a lot of collateral stuff that is in there. Again, we don't have a lot of bonds in this portfolio. Any questions so far?
I have a question.
Yeah.
Mike, majority of the money is in stocks, correct?
Yes.
A lot of it?
In
So
this portfolio, yes.
What happens if the stock market crashes? How do the police officers, where are they going to get the money for the pension?
We'll know well beforehand if something's happening, and we'll begin to adjust the portfolio. If you heard David before, and Amit as well, we're ready to make adjustments whenever we have to in case something like that happens. And that's why I brought that question up with David. What happens if the tariffs go crazy and we have all kinds of problems and we see a recession on the way? We're not anticipating a recession. But if we did see something, we would make adjustments to the portfolios.
Like 2 months ago, when he came out with that, all the stocks went way down. Then when he came back, they all went way up.
They back up again. Exactly right. It went down like 22%, and it's come back about 22%.
Right.
Yeah. Exactly, but we knew that there was there's some compromise in there, and that the markets would rebound, and sure enough, they did rebound. We weren't at a point where we had to worry about the stock market. We weren't worried about what's happening in these markets at all. We gave it time. It all rebounded, which it usually does all the time. But we're ready if we have to make adjustments. As David said, we have to pull back on the stocks. We got to pull up on the bonds and so forth. We have to readjust and rebalance the portfolios to anticipate what's going to happen in the markets.
So you watch this every day?
All the time. Yes, we watch
That's
the
all he
markets
does.
every day.
No, I know. I'm just saying, like the Bridgeport one. I mean, you must have a lot of them.
A lot of bridge. I've got a lot of accounts, right? But I watch the markets all the time, and I know pretty much where everybody's at, and I know when to make changes. So we're prepared, if necessary, to make those changes to protect the portfolio at all costs. All costs.
Thank you.
And we've been through an awful lot, and I'll talk about that in a couple of minutes. What we've been through, and you'll see what I mean when I say that we're prepared for pretty much anything. We've been able to write out an awful lot of stuff in the time that we've been doing this. Good.
Thank you.
Good question. Okay, let's go to global exposure next. All right. We have over 90% of our investments, bond and stocks, in the United States, which is where it belongs right now. The United States has a very strong economy. Corporate earnings are great relative to overseas. The foreign stock are very slow to rebound. Since COVID and even before, the economies overseas are weak relative to the United States, which is why we have, in this portfolio, we have most of our investments are in the United States. When things turn around overseas, if they turn around overseas, then we might reconsider that. But right now they belong in the United States. We only have a tiny bit in Asia, a tiny bit in Europe, and the rest is in the United States. And this is prudent for us because we're fiduciaries of this plan. We have to make sure that we're careful and we're conservative. We also, overseas, you've got geopolitical issues, the Mideast crisis, Ukraine and Russia, and of course, Syria cropped up today out of nowhere. So we got a lot going on over there, and something we've got to be careful of and keep an eye on. Okay, this is portfolio performance. There are 4 charts on this particular page. If I can draw your attention to the chart on the upper right-hand side, it's called value over time. See that value over time. This chart begins in 2002, actually, 2002. There are two lines on colored lines on this chart. The blue line represents money that comes into the account or money that comes out of the account. That first step down, that big step down, that was the MERS transfer when we transferred money out of the MERS plan, out of the this Raymond James plan into the MERS plan, and that was during 2013. That was a big transfer. As a matter of fact, the entire transfer of the Bridgeport Police Pension Plan B was $80 million. We were left with 60. That's how much money came out. So all the managers, we had to take money from all the managers in order to fund the MERS plan. So you see that blue line is, heading down. We've got a couple of other withdrawals that I took out, I think about $10 million worth, and I sent to the other managers because they were getting a little bit low. The green line, on the other hand, are the returns. It shows you what the returns have been. And you can see on the right-hand side, the gap between the green line at the top, which are returns, and the blue line, which is the cash that was put into the account and take it out of the account. The gap is getting wider and wider over time. And that's what we want. We want to offset the withdrawals coming out of our plan, and we want to build a future value in the portfolio so that we can offset if the market goes down, if we have problems, if there are all kinds of geopolitical things going on outside of United States. We want to be prepared. We want to have not only enough money to handle all the retiree withdrawals and distributions, but also in the event we run into rough times. We want to have a good backup and a good buffer for ourselves. Okay, and if you look at the bottom right-hand chart, right underneath the value over time chart, this is the asset growth chart. This is dollar values in this. And if you look at the very bottom, all the way down at the bottom right-hand corner, I don't know if you can read it in this chart, but you can see it on yours. This portfolio alone, Raymond James, has made over $42 million since 2002. In fact, since the MERS plan and the transfer of money in 2013, in this portfolio, we've actually made over $27 million since just that time. So, I'm sorry, was there a question? Okay, again, we want to stay. We want to stay one step ahead as much as we can, depending upon what happens in the markets or elsewhere. All right, and then the next page. This is just annualized returns for mutual funds in the portfolio for different periods: 1 year, 3 year, 5 year, 10 years, 15 years. There are no negatives in this chart, which means that we've got, these are highly diversified mutual funds. They're high rated, good quality, and suitable investments. And this plan enhances what goes on with the other two plans, the other two managers' plans, Estabrook and Wright. Okay. This is the summary, and again, I'm sorry this is so small, but this is the summary of the three plans, the three managers' plans together. There are three sections to this summary: the manager's allocation and the history down below. We'll start with the managers: Estabrook, Wright, and Raymond James. Right now, the market value of the Estabrook account is a little over $10 million, or about 14% of the entire portfolio. Wright Investor Service is about a little over $27 million, or about 36% of the portfolio. And Raymond James is $37 million, or about 49% of the portfolio. And it's pushing up against the ceiling right now, Raymond James. All told, we have about $75 million in this portfolio, $75 million. And I'll put that in perspective in just a minute. What I'd like to do, and I'm going to need your approval on, is to move $5 million from Raymond James into Estabrook to build up that portfolio. They're doing a good job. I'm happy with the performance of both of these guys. And I'd like to just get Estabrook's up a bit. Anyway, $5 million is what I would recommend at this point. We look at the second section there, allocations. It's what we discussed before. We've got about 23% in bonds in this portfolio and about 75% in stocks. This is a good balance between bonds and stocks. Bonds aren't paying very much. We're getting dividends and we're getting income from and returns and gains from stocks. And while we're in a semi-growth period, and when the economy is doing well, we should continue with this allocation and the ratio between bonds and stocks. It's the right number to be in. This is very, very important. So this is a good allocation, 23% bonds and 75% in stocks right now. And these are all good quality stocks, well-managed portfolios. We don't have to worry about that. That's a good allocation. If something should happen, if the market should go to heck of a handbag, if these tariffs get out of hand, we can adjust those numbers. And we've done it in the past where we reduce the stock allocation and we've increased the bond allocation, or we might increase the cash allocation as well. Okay, at the bottom, the last section of this summary, this is the history. And if we look at December 31st, 2013, that was the period right after the transfer of $80 million to the MERS plan from the pension plan B. We had to move $80 million over. We were left with $60 million, a little over $60 million starting in 2014, January 1, 2014. Since then, we have withdrawn a little over $42 million for retiree distributions, $42 million. And since we've got $75 million now, we have a return or a gain of over $55 million still in the portfolio, $75 million. So, we've done pretty well despite some hard times, which we've encountered, as we were just starting to talk about before. Recessions, China scare, COVID, Ukraine, Middle East crisis, banking crisis, and tariffs, all within this time frame since 2013. So we're keeping our head well above water here, plenty of money for the retirees well into the future. And that's our mission, is to keep this going, despite all the problems we've had in the markets and geopolitically and administrations and so forth over time. So I think we're doing our job, and so far, so good.
I'm going to have to agree, and I've been on the board for longer than I care to mention, but I've been working with Mike for several years on this, and particularly when 12 years ago, when the retirees went to MERS and the pension plan B needed to continue with the amount of retirees in the plan, and there was a legitimate fear that at some point the pension plan would go broke because it's not getting the contributions that it had before the transfer. And what the investors have been able to do is not just keep up with the retirement payments that needed to take place, but actually, as time gone by, the net value of the plan has increased, which is nothing short of an amazing accomplishment. I feel the plan has done quite well all things considered, without the contributions that they were getting beforehand, the fact that there's more in the plan now than there was 12 years ago is an amazing testament. There's so many folks out there saying that the pension plan B was going to go broke eventually, with all the payments that were due. But not only has Mike and the rest of our investment team been able to keep current, it's actually showing more than it was when they started not getting the contributions.
Thank you.
It is making enough to satisfy the needs of our retirees. It's plain and simple.
Yes. Yeah. The guys, I speak to the guys often. I look at these statements every single month. And they keep up. If there's an issue, I question them about it. And boy, they've done a great job. All three components of this plan have done well within a reasonable amount of risk. Nobody's taking extra undue risk at all. So if we can keep that up, we'll stay a couple of steps ahead of the market and the distributions that are coming out of the plan. We don't know what's going to happen in the future. There's tremendous uncertainty right now, but the foundation, the fundamentals of the economy are doing well enough that if we can hold our own and we can be careful and be safe with our investments and the structure and our assets are good, and we keep modifying the portfolio as necessary, I think we can, keep going until the last of the retirees, is around. That's what we've got to do.
Right.
That's what our mission is. Any other questions or issues or anything?
Mike, you were looking for an action item from the board.
Yes.
You were making a suggestion of a transfer of $5 million in funds from Raymond James to Estabrook. Is that correct?
Yes, that's correct. Yes. Mm-hmm.
Does anybody have any questions on that?
I did have one question on it.
Yes.
I was just trying to understand. I know you're shifting it over there because they're little. I feel like we did this before.
Yes.
Shift a little. I mean, Wright has been doing an excellent job. You're talking, well, it appears that they've been doing an excellent job. They start off with $1 million, now they're 27 million or however many million in now. So this money would come from Raymond James over to Estabrook, and you would leave everything in Wright. Is that
That's
correct?
right. Well, yes, that's right. That's right. Estabrook is paying for most of the retiree distributions, which is why it does go down at times. And it's important, especially given the fact that we've made so much money, we continue to make money. We've got to shift money over to Estabrook to make sure that they have enough money to pay for the distributions, the retiree distributions. So that's, we need to shift some money around here to give them a hand for these retire. We don't know. All of a sudden they could ramp up. They could be $500,000 per month in distributions. So there's no way to keep up with that. But the entire portfolio is keeping up with it. And if at some point I need it from Wright, I'll also take it for Wright. But right now, Raymond James, the allocation is a little bit too high and it needs to come down. So I've got to shift some money around.
You answered my question. That's what
whether I like it or not.
Thank you.
Oh, you're quite welcome.
So would the 5 million and the allocation go into that cash portion of it, or would it be?
Good question. Yeah, Commissioner. Yes, it would go into cash initially. I'd have to sell and then move cash over. We've done this before a few times. I would move the cash over. It would go into their cash position. They would reinvest, most of that money. and then keep whatever they needed if they need it for the distributions. But it builds up their portfolio. They're doing well, and that's the thing. If they weren't doing well, I'd say, well, no, they don't deserve it. We're not going to do that. But they are doing well. They're doing very well. So I want to keep it going.
Seems like all our managers are doing well, at least hitting the benchmark, and if not a little bit better than the benchmark. So that's the most we could ask for.
Yeah. For now, yes, very good. We've been doing it for quite a while. There's no reason why we can't continue doing it, regardless of what happens in the marketplace or geopolitically. We've been through an awful lot just since the MERS plan in 2013, and we're able to keep one step ahead of it and keep our heads above water. So far, so good. Hopefully.
Any other questions?
No, you've been doing a great job, Mike.
Thank you. Thank you very much, Commissioner. Appreciate it.
Very good job.
Thank you. Thank you. Thank you. Thank you, everybody.
And
great to see you all once again.
the board will need to move the request of Mr. Brewy, and that is $5 million transferred from Raymond James to Estabrook. Does anybody care to make a motion to that effect?
Say yes.
I'll make the motion.
Motion made by Commissioner Martinez. Is there a second?
Second.
Seconded by Commissioner Ferguson. Any questions on the motion? Hearing none. All those in favor?
Aye.
Are there any opposed?
Aye.
Okay, looks like it's unanimous.
Okay.
Motion-
Commissioner Roach, I'll be sending you paperwork as we've done in the past for you to sign electronically, for me to move the proceeds over. I've got to sell the assets to come up with the cash, and then I'll have you sign it, and then we'll ship that over to UBS.
I may reach out tomorrow, Mike, and try to contact you.
Okay.
Just to follow up on one or two items, okay?
Very good. Look forward
right.
to it.
Great.
All right. Thank you,
Okay.
folks. Nice to see you. Have a great evening.
Thank you, Mike.
Stay cool.
All right.
Blessings.
Okay. Take care.
Unless we have anything further, entertain a motion to adjourn the special meeting.
So moved.
It's been moved. Is there a second?
Second.
Moved and seconded. All those in favor of adjournment
Aye.
signify by saying aye.
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 And there's none opposed, apparently. So we are adjourned. Thanks again, Mike.
Okay, folks.
Take care.
Good night, everybody.
Take care.
Good night, guys. Thank you.
Good night. Thank you.
Good night.
Thank you, Yulitza.
One of the,
Thank you, Litza.
Thank you.
Aye.
They're being made right now, but